Hey everyone, this is Yussi. I run a small investment firm that specializes in REIT investing. I've now been investing in this space for well over a decade. I've made a lot of mistakes along the way, some of which have cost me quite a bit of money. And in today's video, I want to discuss some of my biggest mistakes of all time. Back when I started investing in real estate investment trust, there wasn't much educational material about the sector online, and so I've had to learn some of these lessons the hard way, but you can learn from my mistakes, and here are 5 of them. The first and perhaps most important mistake that I've made at times is to be too greedy. There's this saying that bulls make money, bears make money, but pigs get slaughtered, and this applies particularly well to the REIT sector. Looking back, whenever I've invested in REITs that were extremely cheap, trading at huge discounts to the net asset values, low single-digit multiples of their FFO, and double-digit dividend yields, almost in every case I've lost money in the end. A great example here that comes to my mind is the mall REIT CBL and Associates. I invested in this REIT before the pandemic and I ended up losing about 90% of my capital. Back then it seemed like CBL was a great investment opportunity because the mall sector was out of favor. However, its malls were still generating stable or even slightly growing sales per square foot, rents kept coming in, and yet the REIT was priced at less than half of its net asset value, 3 to 4 times its FFO, and it was offering a 10 to 15% dividend yield. I ended up investing in the company and yet I lost most of my money. The reality is that the REIT market may not be perfectly efficient at times, but it's not totally stupid either, and if a REIT is priced at such a low valuation, there's typically a very good reason for it. It probably means that the REIT is dangerously over-leveraged, mismanaged, or that it suffers assets that are facing severe difficulties. In the case of CBL, the main problem is that its properties were requiring a lot of capex just to keep them functioning normally, and as a result, if you now deducted this capex from its cash flow, it was dangerously over-leveraged. And so CBL is a good example of what tends to happen when you buy REITs that are extremely cheap. Typically, it's probably because you're overlooking some key risk factors. But CBL is just one example. There's been quite a few other similar REITs that have lost me a lot of money. Another one that comes to my mind right now is called Unity Group, ticker symbol UNIT. This is an infrastructure REIT that owns a portfolio of fiber assets. For most of its history, it's been priced at a 10% plus dividend yield, just around 5 times its cash flow, a steep discount to its net asset value, and yet it has lost me a lot of money over time. Again, I was overlooking key factors like its leverage, which was quite a bit higher than I thought. The management was perhaps subpar, it wasn't well aligned with shareholders, and other key reasons that warranted the REIT to trade at such a low valuation. Eventually, I stopped investing in these deep value REITs and instead I started to focus more on what I call quality value. These are high quality REITs that are perhaps discounted because they're going through some temporary issues, and when I made this switch, my investment performance improved very significantly. These REITs are not the cheapest or the highest yielding, but they typically offer the best risk to reward in my opinion. A great example here would be Camden Property Trust, which is an A-rated apartment REIT that specializes in Sunbelt communities. It has an exceptional track record, it owns very good assets, it has a strong balance sheet. However, today it's heavily discounted because the Sunbelt markets are overbuilt. There's a lot of supply hitting the market. This is causing its rents to stagnate for now or even slightly decline. However, we think that this is an opportunity because the oversupply will only be temporary. Now new construction starts for apartment communities have already dropped to the lowest point since the great financial crisis, and therefore we think it's very likely that its rent growth will accelerate in 2025-2026, and yet it's now heavily discounted as if its rents will stagnate forever going forward. I just don't think that this is likely. I think that 2024 is an exceptional year for the company, 2025 will be much better, and with that I think that its valuation is also going to recover. So the first lesson here is that you shouldn't be too cheap when investing in REITs, and it's generally a lot better to focus on quality value rather than deep value. Then the second mistake that I've often made is that I have underappreciated capex. Capex is the cost that's required to maintain your buildings in good shape, and at times I've underestimated the impact of capex, and as a result I've thought that the REIT was earning more cash flow than it truly was, and this has also caused me to overstate the quality of the balance sheet or the safety of the dividend. The tricky thing about capex is that it's very bumpy, it can be infrequent, and it can also vary greatly over time. As an example, a REIT may enjoy very low capex for 3 years, and then on the 4th year, it may suffer a major new tenant vacancy, which is then forcing it to heavily reinvest in its building to release it, and so this leads to some bumpiness in the cash flow. Therefore, it's very important to understand the quality of the property, its age, the lease type that you have, who's responsible for the maintenance of the property. In some cases, the lease will actually put this responsibility on the tenant. Also, the supply and demand dynamics for the respective asset class, as that will heavily impact the bargaining power of your tenant. With that in mind, I think that today most REIT investors are underestimating the impact that capex will have on office REITs going forward. I think that they will heavily have to reinvest in their properties as their leases expire, and therefore most investors are likely overstating the real cash flow of office REITs. And so this means that their dividends are riskier than it may seem, they're also more heavily leveraged than it may first seem, and finally they're not quite as cheap as it seems on the surface. Before I go into the third mistake that I've made, could you please do me a huge favor and click the like button? That will help me a lot to grow this channel. And also please know that I plan to soon conduct REIT CEO interviews for this channel, so if you don't want to miss those, make sure to subscribe to the channel as well. My third mistake is that for a long time I would ignore foreign REIT markets, and this was simply because of laziness. I didn't want to deal with the additional headache of having to deal with withholding taxes, having to pay higher transaction costs, having to open the right brokerage account that allows you to invest in foreign REIT markets. But in hindsight, I really should have started earlier, because some of my biggest gains that I've earned over time have been in foreign REIT markets. The interesting thing is that foreign REIT markets are typically quite a bit less competitive, and therefore you're able to often find REITs that are cheaper and faster growing than their American peers. A great example that I have often covered on this channel is called Big Yellow Group, which is the leader in the self-storage space in the UK. I think that it's set to grow a lot faster than its American peers, public storage and extra space storage, and yet it's today priced at a lower valuation than them. So don't overlook foreign REIT markets just because they require a bit more effort. By investing in foreign REITs, you may increase your returns, but you can also diversify your portfolio further, reducing its risks. And it really isn't that difficult these days. There are good brokers like Interactive Broker that give you access to all foreign REIT markets at a very low cost. If you want to open an account there, I have a referral link. I'll put it in the description of this video. That's what I use for all my foreign REIT investments. Then my fourth mistake is that often I have put too much trust in REIT management teams. Today, most REITs are well managed and the incentives are well aligned with shareholders. But there are some exceptions, and I'm not going to cite any specific REITs here, but I've had some REIT management teams lied straight to my face. The best example that right now comes to my mind is a phone call that I had with the CEO of an externally managed REIT, and on that call I was trying to pressure him a bit on the past capital raising behavior of the REIT. They would very commonly issue new equity at a discount to their net asset value to buy additional properties, and this would be dilutive to shareholders, or at the very least it wouldn't increase their FFO per share, and it really didn't add much value for shareholders. But I believe that they were doing so simply to grow the size of the portfolio, which would justify higher fees for the external manager. On that call, the CEO tried to reassure me that they are now done issuing new equity because their stock is too cheap, and that therefore I shouldn't be concerned about this. But then shortly after, they announced another big acquisition, issuing much more equity once again. And this is a good example of a REIT management team that cannot be trusted. And so this is a good reminder that the job of a CEO is often to just pitch the REIT to different investors to convince them to buy their stock. But you should really take anything that they say with a grain of salt, because they are conflicted in a way. A good lesson here might be to simply avoid all REITs that are externally managed, because the external management structure is famous for leading to more conflicts of interest. And while there are some exceptions, there are some that are well managed. On average, the externally managed REITs have done quite a bit worse than in their internally managed counterparts over the long run. And then my fifth mistake is that often I have lost patience too early. I might have made a good investment decision, but I still end up losing money because I end up losing patience and selling too early, perhaps overreacting to some short-term news. A great example of that would be selling a REIT after it had released disappointing quarterly results, not understanding that these short-term results really shouldn't have a major impact on the fair value of a REIT. Real estate, and therefore also REITs, should be valued based on decades of expected future cash flow, and therefore the impact of one bad quarter or even two really shouldn't be significant. And so instead of overreacting to these short-term news, you should understand that the best buying opportunities typically occur after a REIT goes through a temporary setback that causes its valuation to become discounted. So if you're going to invest in REITs, it's important that you maintain this long-term mindset. So you need to think like a landlord, because after all, you're buying real estate, you're earning rental income, and you need to have some patience to see that long-term appreciation. If you're going to overreact to the first piece of bad news, you will never really get to benefit from the long-term compounding of REIT investing. So to recap here, don't be too greedy, don't underestimate the impact of capex, don't in your foreign REIT markets, don't trust REIT management teams, or at least trust and then verify, and then finally you should remain patient when investing in REITs, even as they occasionally go through temporary setbacks. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. This is a real 2-week free trial, which means that you won't be charged anything in the first 14 days. So you can simply join, you can study my portfolio, see some of my research, and if you think there's value to it, you can then stick around and invest with us. But if not, you can simply cancel and you won't be charged a penny. And then finally, once more, if you could please click the like button, that really helped me a lot to grow this channel. Thank you so much in advance, and see you at my next one. Bye-bye.